Welcome, ladies and gentlemen. We are about to start with our virtual roadshow of Sibanye-Stillwater. And with me here is James Wellsted, the Vice President, Investor Relations Worldwide of the company. James, welcome.
Thank you, Jochen.
How are you in South Africa?
It's all good here. It's summer and things are good at the moment. So.
Super, perfect. Yeah, now our attendees are checking in, so we just wait another minute probably before we start with the presentation to make sure everybody is on. Some remarks from my side, of course. You know me. For those who don't know me, my name is Jochen Steiger. I'm the founder and CEO of Swiss Resource Capital AG here in Herisau in Switzerland. And also I'm the chief editor and founder of Commodity-TV and Rohstoff-TV. Our virtual roadshows are a great series which will be recorded, of course, but we are also fully complying to the European and Swiss data security laws. That means nobody can see each other. We do not display any names nor email addresses. And we have today over 82 people registered here. That is fantastic. Thank you very much for that already from all over Europe. Also some from Canada, the US, and of course also from Great Britain, which we highly appreciate. A lot of funds, banks, and investors. This is fantastic. And we are really proud and happy to have such a fantastic company here with us. As I said, we are recording that. James will start in approximately 30 seconds with the presentation. And we just wait a little bit more to make sure everybody is getting in here. Yep, that's fantastic. I see the list. Also, what I want to say is, as you see the vertical gray bar, which is named chat, this is the third position from the top. There you can type in your questions. Please feel free to use that. I already wrote a welcome message to you. And make sure that you use that, because after James' presentation, we want to do a long and very lively Q&A session. Yeah, so I think we're going to get slowly started here, and we have the presentation here. Great. Yeah, ladies and gentlemen, welcome to Sibanye-Stillwater, and this is a real heavyweight in mining. We have the honor and pleasure today to get the presentation from James Wellsted, as I said, the Vice President of Investor Relations Worldwide for Sibanye-Stillwater. Sibanye-Stillwater is the #1 in platinum, the #2 in palladium, the #3 gold producer in the world, and the largest rhodium producer also in the world. So you see all metals you need for security, for safety, for pleasure, and you need for e-mobility and renewable energies and future technologies and digitalization. So from that side, the company, had a great history in the last years of growth. Of course, they also faced some problems operational, but they came completely over it, and the stock performance was outstanding within the last 12 months. But this is what we want to hear now from James, of course, what's going on, what will be the future, the outlook for Sibanye, and of course, we want to talk about the dividend. James, I will start the presentation now. And so let's see what's going on with your company, and the floor is yours. Thank you very much.
Thank you, and good evening to everybody who's attending this. As Jochen said, I'll give a very brief presentation on the company, a high-level overview on recent events and where we are as a group. And again, you can see from the title of our presentation, we are a unique, exciting global precious metals company. And I think we've shown our ability to deliver on our strategy, and we believe that there's going to be the delivery of superior value in line with our vision to shareholders and other stakeholders in future as we carry on delivering on our strategic goals. Again, with most of these presentations, we do include a disclaimer or safe harbor statement. We do have some forward-looking statements in the presentation, so please take note of this. Okay, so really, what is Sibanye? It's a unique, diversified precious metals company. Unique, by unique, I'm referring to the commodity mix. There are no other precious metals company that have got the mix of gold, PGMs, and then the diversified nature. We are the most diversified global PGM company in the world, with operations, as you can see on the right-hand side of the screen, in the US, in Montana. We have 2 mines. We acquired Stillwater in 2017, and with those, we got some other projects in Canada and Argentina, which we are developing with some JV partners. Some juniors are developing it for an earn-in. And then in South Africa, where we've got the bulk of our assets, we've got some gold assets that we inherited on unbundling in 2013. And then we've grown quite rapidly in the last 3 to 4 years in South Africa, becoming one of the biggest, or the biggest producer in South Africa. And we've got operations on the western limb of the Bushveld complex in Rustenburg, and then also in Zimbabwe. I think the key things here, if you look across to the left at the pie chart, is you'll see that our reserves are only 14% of our resources. And you can see the size of the reserve, 70 million ounces. But look at the size of the resources, 493 million ounces. So these are very substantial deposits and long life assets. You can see also importantly is the production mix. You can see that the gold is 31% of our production. Obviously, with PGM prices having done so well in the last couple of years, you can see that PGM is a significantly the US PGM makes up 17% of our production, and then the SA PGM is 52%. But with the prices of PGM doing so well, you can see the proportion of Ebitda that's contributed. So gold, affected by COVID, obviously during the last half, is 15% of Ebitda. The SA operations, which are 52% of production, were also impacted by COVID. So they only contributed 52% of Ebitda. And then you can see that the US is a substantial part of our Ebitda in the half year, and really carried the operations through a period when we had quite a lot of difficulties in South Africa with the shutdown across the whole country of the entire economy. We are listed on the JSE, and we do have an ADR program on the New York Stock Exchange. Moving on to the next slide, just look at our strategic intent, which is to strengthen our position as a leading international precious metals mining company. And that will be achieved in the following way. First of all, by building a values-based culture. Obviously, people are core to our business and are critical to our business. So it's important that our employees make decisions and act according to our values. And that will allow us to achieve our goals and to also achieve them safely. And that follows the next in the gold is ensuring safe production and operational excellence. And we have had some challenges in the last couple of years, obviously growing quite fast, taking on new operations and integrating those operations, but also some operational disruptions, which I'll talk about a little bit later, at our SA gold operations, which have impacted on production. And we've only recently started to restore those operations to some level of stability, and now they are contributing quite strongly financially again. Deleveraging our balance sheets, I think we can put a big tick through. This was one of the issues that was holding back our share price and contributing to us trading at a significant discount to our peers. But we've recently accelerated the deleveraging of that balance sheet, and we are basically now, in fact, well below a lot of our peers in the industry in terms of debt on our balance sheet. We do believe we still need to address our South African discount. South African shares, due to various factors, do trade at discounts to their peers. We are working hard with industry bodies to try and improve the situation in South Africa, engaging with the regulators and the policymakers in order to try and make it a more investment-friendly environment. But that is a longer-term game, which we'll continue to work at. We've also obviously trying to address that discount through diversification, which we've done quite successfully in the last couple of years. And then we may consider in future is an offshore listing, primary listing. We already have a secondary ADR listing in New York, but we believe that there may be an opportunity to really become a proper international company, accessing the international capital markets by listing primary listing in another jurisdiction. And then pursuing value accretive growth. As I've said, we have grown quite fast in the last couple of years. We can only really do that on the back of a strengthened equity rating, and we're not quite there yet. We believe that as we continue to deliver on some of the things I've been speaking about, we will re-rate in line with our peers, and then we'll be in a much better position to really continue creating value for our shareholders. And then in the middle there, you can see ESG, which is a core focus throughout the business and runs throughout all of our everything we do. This is something that we've taken on board as a primary focus area. And obviously, as you know, around the world, ESG is becoming a significant filter for investors. So just talking a little bit about our ESG credentials. First of all, we recently got accepted as a member of ICMM in February this year. Now, as you know, that's an industry body which has got very, very strict and rigorous evaluation process that you have to go through to become a member. So it was very pleasing that we were admitted as a member of the ICMM earlier this year. And I think it gives credibility to our ESG credentials or our focus. We achieved an A rating on the Carbon Disclosure Project, which is a climate change disclosure agency. And we were one of only 179 companies globally and only one from South Africa who achieved that. We also were included in the Bloomberg 2020 Gender Equality Index. Again, one of 325 companies globally and one of only 8 South African companies. So very, very solid achievement. And then we've been re-included in the FTSE Russell ESG Index on the JSE and won the annual Rand Water Awards as one of the most collaborative and water-saving companies in the South African mining industry. And obviously in South Africa, as you know, water is a big issue. And this is a good testament to the efforts that we're making. We are also a member of the World Gold Council and as a result aligned with all the responsible gold mining principles. And then on the right, you can see at our Stillwater operation, our US PGM operations, we've just recently marked or celebrated 20 years of a world-class agreement, which is called the Good Neighbor Agreement, which really governs the relationship between our operations, the environment, and the stakeholders in the area, being the community and other people in the area. And this is a collaborative effort and something that we feel is world-class and industry-leading that we will now be also bringing across to South Africa in time. Moving on to our commodity exposure. As I said, this is what makes us quite unique. And you can see over the last 3 years, the top performing commodities in the world. And we produce 8 out of the 10 top performing commodities in the world. And in fact, in a number of them, rhodium, ruthenium, iridium, platinum, we leading producers in the world with palladium, only Norwal's nickel being bigger than us. As you can see, rhodium has produced a performance of over 1,000% in the last 3 years. It's actually gone up even higher recently. That makes up about 4% of our production mix, but you can see how important a contribution it makes to our revenue. It's over 25% at current spot prices. Palladium as well, you can see 28% of our metal that's produced, but about 43% of our revenue. Going forward, we do think that platinum, which has been the biggest underperformer out of the PGMs, that has got a very, very strong outlook and that we believe will outperform its other PGM metal peers over the next couple of years due to a lack of capital investment in South Africa in the PGM mining industry, but also due to the burgeoning hydrogen economy where platinum will play a huge role, fuel cells, and then also some strategic substitution of palladium in gasoline auto catalysts with platinum. So moving on to the next slide, just to show you that last year we went to the Denver Gold Forum, and we said that we would be re-rating. This was following a 5-month strike that we had had at our gold operations, which had severely impacted production and earnings from gold. And then also after the acquisition of Lonmin, which was an independently listed PGM producer in the UK and JSE, and a substantial PGM producer. And we said that now we were through these 2 issues and had brought Lonmin on board, we believed we would begin our re-rating. And indeed, that was proven. We outperformed, and you can see the names there. It includes the South African PGM and gold stocks, but also some of the bigger internationals, Norilsk Nickel, Newcrest, Barrick, etc. And we outperformed all of them over a 12-month period. And even with this performance, what I'd like to show you a bit later on is that, we've largely, we have outperformed, but we still are significantly undervalued relative to a lot of these companies, and that there's a significant re-rating that we believe will come in the next couple of years. So just now touching on a few operational issues and focusing on the operational performance for the first 6 months of the year. Obviously, everyone was affected by COVID.
No problem. It's family. All good. It's easy.
Sorry about that.
Don't worry.
Everyone was affected by COVID. But, we believe we followed a very responsible approach to managing COVID. You can see the graph on the left shows the impact, particularly in South Africa, where on the 23rd of March, essentially the government shut down the entire economy. And as a result, we were unable to produce anything really through April. And only at the end of April, in early May, and subsequent to that, have we been able to resume operations. Fortunately, and again, testament to the importance of having a diversified portfolio, is that our US operations were largely unaffected, outside of having to take on social distancing measures and to comply with those regulations. And how they managed that was by halting non-essential growth capital at one of their projects called Blitz. But then as a result, they were able to continue operating throughout, and were a very important buffer for us, producing significant earnings, as I showed earlier, in the first half of the year. The US PGM operations achieved about 89% of planned production in Q2 due to those social distancing measures. The SA operations were significantly impacted, as I said, with the SA gold operations only producing 54% of planned production in Q2, and the PGM operations only producing 47% of planned production during Q2. Fortunately, as you will see, despite this production impact of COVID, we were able to produce a very, very good financial performance for the half, and that has started to come through and enabled us to deleverage, and obviously, as Jochen said, to resume our dividend. I'm happy to say that even with a very measured approach to building up production since May, we're now close to full production at both of our SA Gold and PGM operations. So going into the end of the year with metal prices again at record levels, the outlook is very, very solid for the second half of this year from a financial perspective. And here again, as I'd like to highlight, we still managed to achieve a record performance for the first half of the year, despite COVID. Q2 was heavily impacted, but it was anchored by obviously a strong Q1 performance. And again, we expect a similar performance at the end of this year. We had an 8 times increase in adjusted Ebitda year on year, with Ebitda going to 990 million from 142 million in the previous, the same period the previous year. And importantly, is that 94% of the earnings were from operations that we acquired through our PGM strategy. And you can see that in the graph on the right, where the gray bars is the US and the blue bar is the South African PGM earnings. And then the gold, as you can see over the last couple of years, has been loss-making due to the disruptions that I spoke about, but is now coming back into a profitable position and will be contributing a lot better going forward. But because of this increase in size with Marikana integration or Lonmin integration proceeding well, we've already managed to more than double the expected synergies that we thought we would get from putting Marikana together with our existing operations. So that's increased from 730 million per year to 1.85 billion per year this year already. And we only expected that 730 million over a 2-year period. So that's been a very, very successful acquisition. We've already repaid the acquisition cost of Lonmin in 1 year from net cash flows from operations. So very, very good acquisition. And as a result, you can see the dotted line on the right. Our gearing has fallen from 2.5 times, around 2.5 times a year ago. We're now sitting at 0.55 times net debt to adjusted Ebitda. And this graph will just give you an idea of how we are going to proceed with that deleveraging. A lot of that net debt to EBITDA, to adjusted EBITDA deleveraging occurred through an increase in EBITDA earnings growing. We still wanted to reduce our debt, which was sitting at about 1.5 billion at the middle of the year. And how we'll achieve that is we've recently announced a soft call on a convertible bond that we had issued in 2017 in order to conclude the acquisition of Stillwater. And by exercising that convertible or the call on that convertible bond and converting that debt, we will more than halve our net debt again. So our net debt to EBITDA will then fall to about 0.23 times by the middle of this month on the 19th of October. And most likely by the end of this year, we'll be in a net cash position. So a significant change in our fortunes in terms of balance sheet. We now have a very, very strong and flexible balance sheet. And this is one of the areas, as I said, that had been mentioned by analysts and investors before as a risk and why we were trading at a discount to our peers. And obviously being able to reduce that debt has now put us in a position to resume our dividends. Prior to 2017, when we acquired Stillwater, and Stillwater was a significant transaction, we had to borrow effectively $2.7 billion to do the acquisition. We were a $2 billion market cap company at the time. So it was a very, very bold move, but one that thankfully has paid off very well, with the PGM prices and palladium certainly more than doubling since we acquired those assets. And as a result, you know, our earnings have increased substantially, and we were able to resume our dividend. Prior to buying Stillwater, we paid an average yield of about 5%, and we would like to get back to being a leading dividend-paying company. The dividend that we announced, which was 50 cents or equivalent to 11, just under 12 US cents per ADR, is lower than our policy. Our policy is to pay 25 to 35% of normalized earnings, but we declared a 15% of normalized earnings at the interim period, and that was due to COVID and some remaining concerns about the potential for second wave, etc. But certainly in South Africa, it doesn't seem as if that's happening, and it's very unlikely that even if we do get another spike in COVID cases, that it'll affect the industry again. So the outlook is very, very solid for a very big dividend towards the end of the year, when the board will again reconsider the dividend in light of the full year earnings. And again, as I said, you know, we've got good assets, we've got good ESG credentials, we've shown a solid operational recovery after some difficult disruptive events in 2018 and 2019. We were exposed to the right commodities at the right time, and that's coming through in our earnings and financial performance. And we've outperformed our peers over the last 12 months. We've also deleveraged our balance sheet now to a point where we're going to be, as I said, have literally net cash by the end of the year, and we've reinstated our dividend. So it's a good story, but we believe that even with the good performance that we've had in the last year, that there's more upside. And as you can see from the graphs below, which are some of the metrics that analysts use to compare companies obviously in the financial world. So EV to EBITDA, you can see where we're trading at somewhere around, call it a midpoint of 3 times over the 2020 and 2021. Our PGM peers are trading at about 5 times. Our intermediate gold peers internationally are trading at about 7 times. And then the senior golds are trading up at 9, 10 times. So significantly more higher rated by the market. Obviously, the golds have outperformed in the last couple of months through the COVID period. But even before that, they were still trading at significantly higher ratings than Sibanye-Stillwater. And it's the same with the price to free cash flow per share. A lot of the analysts are estimating for this year and next year over 20% free cash flow yield. And as a result of that, and because our market cap is so low relative to our peers, we're sitting on free price to free cash flow per share of 3.5 times this year and 6.6 times next year. So, and these cash flow estimates are prior to obviously these high prices we've seen in the second half of the year. So there's significant upside, we believe, from where we are now, and we expect it to continue towards the end of this year and into next year. So I think with that, that in a nutshell and a relatively high-level overview of the business, maybe we can get into a little bit more detail with some questions. Jochen, I'll turn it over to you.
Perfect, super. James, thank you very much. Great presentation, and I love it short and on the point and on the spot. So there is a first question from our friends in London. They want to know what is your current relations situation with the South African unions. As we remember, there was that heavy strike last year, which affected you quite heavily. And so can you elaborate a bit on that?
Yeah, I mean, the relations, you've got to look at it in 2 levels. So on the ground and at the operations with the employees and then the people who represent them at our operations, we've got very solid relationships, actually. But at the national level, where you've got leaders of some of these unions who often have political aspirations, there's often different agendas which do affect the relationship. So, for instance, the gold strike, the strike we had at our gold operations last year, we don't believe had anything to do with employee wages. And ultimately, after 5 months of striking, they ended up going back and signing the same increase that the other 3 unions had signed in September the year before. What it was all about, and they had also opposed this in court throughout that period, was that they were trying to block the Lonmin transaction. Because back in the day when Marikana tragedy happened, AMCU's entry into the PGM and gold mining sector, they were previously a coal mining union. They got in through the disruption that was caused by Marikana and the events around Marikana. So their power base really was at Lonmin, and as a result, they were trying to derail the Lonmin transaction for their own personal interests. Fortunately, we did stick it out, and ultimately the strike was called off. And then they also pulled all of their opposition to the Lonmin transaction, which we concluded in June. We went straight into a phase of reviewing those Lonmin operations, and then also into, at the same time, negotiating the PGM wage negotiations. So straight after that gold, we negotiated wages at Lonmin and at Rustenburg, which are other big operations. And those went very, very smoothly. There were no disruptions. They were settled in a matter of weeks and at very, very favorable levels. So really what I'm trying to say is that, there's always potential for labor disruption. But I think the stance that we took during the gold strike, where we said we're not going to be pushed around or bullied by some of these stakeholders who've got other agendas, has really reset the relationship. And as a result, since we've taken over, we ended up restructuring Lonmin, reducing the workforce by about 20%, and there was no disruption at all from the unions. So I think we're on a much more even keel. Also COVID, because COVID had such a big impact on people's threatened jobs, etc., and livelihoods. What we've seen is, since the employees have returned from basically the lockdown, we've had much better attendance at work. So we used to have about 18 to 20% of people unavailable for various reasons, sick or leave or just not turning up for work. But I think people have realized the value of a job. So we're seeing a much better motivation. And also at Lonmin, because they're doing so much better, people are very much more motivated. They're seeing the financial rewards that they can achieve since we took over Lonmin, which was always in distress. And as a result, we've got very good relationships on the ground.
Fantastic. As you have bought only assets in the last years, of course, there's a question also from London. Do you have any projects or assets to sell?
So we do have some assets to sell in South Africa. There's some gold assets that we have been trying to sell, but obviously South Africa is not necessarily a destination of choice. As I said, it's not a highly ranked investment environment for international companies. So typically we would be selling to local companies. And as you know, in the gold sector, the other South African company that's been buying has been Harmony, and they've been buying Anglo Gold assets who have now basically exited the country. So, for now, not much opportunity. And in fact, we wouldn't be selling right now. As I said, we receiving the benefits of now having stable operations with higher prices. We do have a number of projects in the PGM sector that we acquired through Lonmin, which are potentially some of the best projects in the industry, and we're busy reviewing those, and we'll make a decision depending on the overall environment whether we actually develop those or not. But there's a lot of potential there.
Mm-hmm. There's another question also regarding your projects in Chile and Canada. How active are you there, and when do we see some progress or a potential sale?
So we're not very active there ourselves. As I said, we previously were developing them, and now we've entered into agreements with Marathon or Generation Mining at Marathon, and then Regulus Resources at the other projects, and they essentially are developing those, so doing the drilling and proving up those resources, and then over time we could either sell them or maybe even take a bigger stake again, depending on how positive those projects look. So at the moment it's still quite early stage, so we haven't made any decisions there.
Fantastic. I want to come back a little bit on the financial side. First of all, I would love to start with the dividend. Thank you very much. I was quite happy when I saw it in my account because I'm a long-term shareholder. And would it be the case to say by 2021 that we can expect that you go probably back to your old policy saying, okay, 5% dividend yield is a must?
As I said, we've got a policy which is that it's 25 to 35% of normalized earnings. But I think if you look at the cash flow potential over the next couple of years, that could be well above 5%. It seems to be very likely. What we are also considering, and the board will consider this probably at the end of the year, is that we are looking at potentially paying out all of the net cash from our gold operations, all or part of the net cash from our gold operations as an additional dividend over and above our normal policy. And the reason for that is that in the market, I think because of the issues we've had the last couple of years at the gold operations, we don't believe the market really gives much value to those operations. And by declaring a dividend, a tangible dividend from those gold operations alone, we believe that will result in a more realization of value and people recognizing the value at those gold operations.
Okay, so there came once again a question in. The question was, will the unions make more trouble in the next months?
Probably not. We currently negotiating wages at Kroondal, which is one of the small operations next to Rustenburg, and we basically, I think we're very close to agreement on that. So it's highly unlikely that there will be any disruptions.
Great. So let's come back to financials. My friend Marco is asking, what is the actual PE ratio? Sorry, maybe I have missed that. I have missed that probably too, but can you tell us maybe if we look with probable results by year end?
Yeah, listen, I can't give those kind of forecasts. We don't give financial forecasts. We normally only give the operating forecasts. But I think you can expect that the PEs are single digits and substantially below our peers, much like you can see with the Ebitda there.
Fantastic. Then also let's go back to some more financial, because you said that you have a soft calling of your convertible bond. Does that mean that the people are, let's say, able to convert, but they are not forced to?
Yes, they will. Yeah, they're not forced to convert. They can choose not to convert, but then we have the option then of buying the debt at face value, and because the share price has gone up so much, the value of the conversion is going to be a lot higher than the face value of that debt. Almost double. Yeah.
Okay, so that would mean, if I do my math correct, that maybe by year end you are already debt free.
I think that's, as I said, with the conversion of the bond, that will take place by the 19th of October, which is a week away. And then we'll be at 0.2 times net debt to adjusted EBITDA. So by the end of the year, I think we're in there's a good chance, unless there's something else that happens, huge second wave of COVID or some other disruption, there's a very solid chance that we are going to be in a net cash.
Yeah, of course. I mean, this is always under the assumption that everything goes now the normal way. That is for sure.
If you look at how gold price, PGM prices, the baskets at records. I mean, we're receiving all-in sustaining cost margins of over 50% at both our SA and US PGM operations, and at our gold operations at R1 million a kilogram. It's about a 30% margin as well, a 25 to 35% all-in sustaining cost margin. So very, very healthy cash flows.
Super. Then there is a question here out from Geneva, I think. When will we see the next acquisition in South Africa, or where otherwards? Meaning, will you grow the company again through acquisitions, or do you say, maybe let's pause a little bit and consolidate everything? Now we are debt free. Let's concentrate on the optimization of everything and the integration. Maybe you can say something on that.
So I think we have paused that for quite a while. I mean, people forget that when we announced the Lonmin transaction was in December 2017. So we haven't done any transactions since then. And yes, I mean, obviously our focus has been on deleveraging, integrating the operations, stabilizing the gold operations, and then resuming the dividend. So we've achieved that. We are an acquisitive company, but we do have a lot more options now than we had as a 3-asset gold company in South Africa. We've now got global assets. We're already developing a growth project in the US, which will increase production by about 40 to 50%. And in South Africa, we've got some growth or projects at our gold operations we're developing, but we've got very attractive PGM and some gold operations in South Africa, which obviously we're reviewing, and will also, potentially for capital allocation in those. From a acquisition perspective, we're always looking for value if we can. We would like to, and we've spoken about it before, is to diversify our South African gold portfolio by moving internationally. We think that it's too exposed to South Africa and obviously has a limited life, and we like the gold environment. So, we spoke in February. I believe there was a Bloomberg article which spoke about the fact that we were potentially looking in the range of 4 to 6 billion acquisition. Now, at the time, what we were talking about was the kind of size, a 1 million ounce plus gold producer, which would effectively diverse our gold portfolio. But obviously with gold prices and the re-rating of the gold shares and the M&A in the gold space since then, that 4 to 6 billion rand tier of companies are now 13, 15 billion rand companies. So I think the opportunity to do a value accretive transaction in gold is a lot less at the moment. Another area we have said we are looking is in the battery or tech metal space. We bought a group called SFA Oxford in January last year. They're a think tank research house who are very well known in the PGM industry. They do a lot of fundamental analysis on PGMs in the past, and then over time had been doing a lot of other metal research for auto part manufacturers, fabricators, and the OEMs. So we acquired them, and they've been doing bespoke research for us on effectively the outlook for the drivetrain, battery evolution, what metals are going to be essential for the evolution of the battery and fuel cells, etc. And they are still busy with that research. It's quite a big suite of metals, from lithium, cobalt, vanadium, obviously all the way to copper, nickel, etc. So they're doing that work, and maybe next year, middle of next year, we'll be in a position to really say, we like the outlook for that sector, and we've identified certain high quality assets that we would like to get involved with. But it's unlikely to be of the scale and the kind of growth that we saw in the PGM sector. It's more likely to be smaller acquisitions or even joint ventures with some of these battery metal companies that are trying to develop lithium deposits but struggling with funding, etc. So we're looking at those kind of models as an option as well.
So that means you would diversify a little bit from, let's say, the precious metal side to, let's say, battery metals, e-mobility, renewable energy metals, I would call it.
Yeah, I mean, it makes sense for us. I mean, obviously, battery is obviously a future in the drivetrain, in the future as you say, mobility. And we're already in that space with PGMs, in catalysts and potentially in fuel cells. And then obviously, platinum's got a significant role to play in the future hydrogen economy as well as a catalyst to produce hydrogen. So there's a lot of linkages that make a lot of sense for us. If you are going to get penetration of EV into the traditional internal combustion engine segment in the car park, we'd also like to participate in that space going forward as well.
Which would you consider to be the most important battery metal in your perspective is a question here. That's interesting.
Yeah, no. And unfortunately, we're not in a position, like I said, I mean, a lot of work has been done. We don't have the outcome of that research. So we're looking really at the fundamentals, supply and demand for those metals, what is the outlook like? And then also on top of that, what assets are there that show the kind of potential. We want to buy high quality that can differentiate us probably at the bottom of the cost curve and in terms of grade and extractability.
Yeah, absolutely. One question in between: what number of shares will you have outstanding after the full conversion of the bond? Can you say that already?
Yeah, so it's already out because the JSE effectively has listed those shares. So the shares you saw on the front page, sorry, I'll just pick it up now, of the presentation. No, sorry, that's up. It's about 2.97 billion at the moment. But depending on whether, if there's not full conversion, what they'll do is they'll cancel some of those shares. But I think you can assume it'll be about 2.97.
Okay, super. So then, looking at your reserve base, what's the average mine life? And if you compare your reserves to your best peers?
Yeah, so I mean, obviously in the gold space, our reserves are not significant. We've got about 11 or so million ounces of reserves. So our gold assets are relatively shorter life. They're still quite long life compared to a lot of international gold assets. I mean, the shortest one, Beatrix, is about 6 to 8 years. Driefontein's about 8 to 10 years, and then Kloof is about 13 years. And that's also why we'd like to buy international assets to try and offset that decline. Our PGM assets, Kroondal, depending on whether we can reach agreement with Anglo Platinum to mine across the border into Rustenburg, has got about 6 to 8 years life. Then Rustenburg is long life, it's 20 years odd. And Lonmin, at the moment, if we spend no capital on projects, has probably got life until about 2030. But obviously, if we do develop some of those projects, they'll have 30 plus years of life. And then Stillwater, again, or the US PGM operations are 30 to 50 year life as well.
Okay, let's come back to the acquisitions. Would you consider to stay in, let's say, the African continent or Namibia or whatever, or further, meaning South Africa and then further north? Or would you say, you know what, African continent and the US, this is enough for us to handle? Or could you imagine to buy something in Australia?
Yeah, listen, it is difficult to operate around time zones like that, obviously, and especially so diversified and so distinct. We like the US space. You know, I mean, you've seen they've just again putting out legislation which is pro-mining. We've had a very good experience there, and we're forming a very solid base there. So, you know, we would like to probably continue growing in that area, the North Americas and South American region. But obviously it does depend on opportunity, and if we see some value, clear value elsewhere, we will look at it. But we're not really focusing on Africa, and I wouldn't say Australia is a huge focus.
Okay, super. Given your, let's say, low valuation, which you just described in the presentation, are you a little bit in fear, or let's say even in danger, that Sibanye will be taken over? And do you have the shareholders to prevent something like this?
So, yeah, listen, I mean, you know, obviously we've got an attractive suite of assets, but again, I think the difficulty because really only an international company, a big international company could buy us. And I'm not sure that there's a huge appetite to invest in South Africa at the moment from the international perspective. So I think from our peers in the PGM space, no, because they would hit competition issues. And that's probably why we don't have much more opportunity to grow in the PGM space, because we're already one of the biggest in the world. So I think there's a very small to minimal chance of that happening. Yeah.
Okay, super. And who are your largest shareholders, or let's say controlling shareholders, if you put them together?
So we had a group called Gold One, which is essentially a Chinese consortium that we had bought an asset from in 2014, and they owned between, over time, 17 and 20%. But they've recently, well, since February, been reducing their stake due to their own debt issues that they had, their parent company had. And they're down to below 8% at the moment. The other bigger shareholders are the what we call the Public Investment Corporation in South Africa, which is the government pension funds. It's the biggest investment institution in South Africa, and they own just under 15% at the moment. And then our other big shareholders are, you know, the international institutions like BlackRock, VanEck, Fidelity, and then local South African investment companies like Investec and Old Mutual, etc. Yeah.
Okay, super.
So we've got quite a diversified investor base.
Yeah, fantastic, and some very, very good names, which are also long-term oriented, which is important. Would you consider, in addition to your dividend, a share buyback program?
Yeah, so it is something we've considered. I mean, obviously, you know, we want to reinstate the dividend first, and we'd like to pay appropriate dividend in line with our policy. But obviously, if we are now building up significant cash, we buyback with our share price trading at so much below fair value would make quite a lot of sense as well. So yes, it is something we will look at.
Then there's a question out of Munich. To what extent have you done maybe hedging transactions? On the one hand, for the currency, for example, Rand, US dollar. On the other hand, on the commodity side, which commodities are maybe price hedged? To what extent? Whoa, duration and percentage of production. Yeah. Wow, maybe a general view is fine. It's very detailed.
So last year when we were having the gold strikes, we did hedge some of the gold production because of the concern about the ongoing basis from Driefontein particularly. But we virtually, I think we're out of those hedges now. Those have all been delivered into. They were all at around 850 to a million rand a kilo, 850,000 to a million rand a kilogram. So not far off from where we've been. We did put in place also a palladium prepay, I guess, essentially, or hedge, but that was at $1,500 per ounce floor and $3,000 cap. So that's well in that's still a way off from breaching that cap. And then that's about it, really. I mean, we've got at Stillwater, in order to finance that, we did a stream in 2017, but that's a life of operation stream with Wheaton.
Mm-hmm. Okay, then let's come what I call the $1 billion ticket for Sibanye, uranium. You have a lot of uranium reserves, and of course they are on tailings. So you have done nothing so far with that. Can you give us some words on this? What might be the plans? What prices you would consider to produce out of those tailings?
Yeah, so you're right, Jochen. They basically where those reserves came from. Essentially, uranium is associated with gold in the Witwatersrand, which is where we mine in South Africa, and as a result, the mines used to produce uranium and gold and silver as a minor byproduct. But then in the 70s and 80s, when the uranium prices collapsed, they basically decommissioned the uranium plants, and from then on. And Cook particularly was a very high-grade uranium operation. They were essentially just depositing the uranium with the tailings on tailings facilities for the last 20 to 30 years. So we've got a significant, it's about 60 million pounds of uranium on surface there, and it's very low cost to obviously mine. We would need to build a sizable uranium processing plant. But certainly, and the reason we didn't do it was because uranium was trading in the low 20s up until recently. So currently today, I see the uranium spot price is about $32 per pound. We'd probably need to get to about $40 to $45 before it was really viable. But yeah, there's a lot of opportunity there through that exposure. Yeah.
Yeah, as I think if you can produce out of tailings, this is much, much cheaper. Probably production costs like Kazakhstan has, for example, and around the $18 to $20. I could imagine, not you said that, I said that, of course, because of the regulators. So I could imagine that this would make a significant contribution to future profits. And yeah, that's fine. So then next question, what's going on with your recycling business? Because as far as I know, in the US, you are one of the largest auto cuts recycler in the world. And I think this is environmentally an outstanding business, really, to recycle that material. And on the other hand, I'm pretty sure it makes also a nice amount of money.
Yeah, it does. I mean, it's a steady margin business. We do try and because obviously it involves quite a lot of working capital because you're buying a lot of catalyst material from the collectors, and we try and hedge out that risk by really fixing the price. So we get about a 4% margin on it, but it's very good. $30 million of profit from that operation. So it's a very solid operation. We are one of the biggest in the world, and as you said, I mean, other than producing these metals, which are essential to try and clean the air and for things like the hydrogen economy, etc., the recycling is a big bonus because we essentially cleaning up the environment. We'll get a lot of benefit, ESG benefits from that. So yeah, it's a very good business for us, and one we'll continue to develop in future. It also gives us very good insights into the secondary market for PGMs, which most other producers don't necessarily have.
Fantastic. Last question from my side. Where do you see the biggest risk for the company today?
Listen, I mean, I think South Africa, coming out of COVID, economically, it's had a huge impact on the country. We've got already issues with electricity supply here. There's a big potential socio-economic issues in the communities around our mines, which can cause disruption at our operations. But, we are managing it. We've got a very proactive approach with community engagement, government stakeholder engagement. And we believe the government is currently producing a plan, an economic plan to try and recover the economy, really. And if that is implemented and it's appropriate, I think that, potentially the future could be quite good. But certainly at the moment, our biggest risk is electricity supply and cost, and obviously the socio-economic pressures.
Fantastic, great. So let me check again if I missed a question here, but it does not look like. Great, because we are almost nearing the completion of the hour, and that is great. So because I know you also have some further appointments like me. Yeah, I think we answered everything. That's fantastic. James, thank you very much. That was a great hour with you. I'm a happy shareholder, and as I know, a lot of our viewers here are too. And look really forward to the next dividend by year end, the interim dividend, the next one. That is great. And keep us posted on everything, of course. And I'm pretty sure we talk very soon. Thank you very much.
Excellent. Thank you very much. And thanks to everyone who listened. Thank you.
Thank you. Yeah, ladies and gentlemen, thank you very much for participating in this virtual roadshow with Sibanye-Stillwater. I think it's quite obvious. The Sibanye-Stillwater management has done an outstanding job over the last years. The company is becoming almost debt-free by year end. They restarted to pay a dividend. The dividend yield shall go in the area of 5%. This is something what they want, what they have on their wish list, of course, and I think they can achieve it. Also, you saw the company is highly profitable and they are in the right business. Those are all the future metals we really need for digitalization, e-mobility, hydrogen, electric, etc., etc. And I think the diversification here with Africa and also the US is a very good step, but they have also some projects for future growth. And the company is on a fantastic path of growth, and maybe a share buyback. This is also possible. We view it very positive, and you should really check out the company again. So thanks for watching us. Bye-bye from Switzerland, and bye-bye and good night to South Africa. Thank you very much.